afternoon. Thank you for joining us today for Pinecliff Energy's operational and macro update. Pinecliff trades on the TSX under the ticker symbol PNE and on the OTCQX under the ticker symbol PIFYF. With us today from the company are President and CEO Phil Hodge, CFO Kristopher Zack, and VP of Operations Terry McNeill. There will be an opportunity for questions after the presentation. Please enter your questions in the Q&A box. Congratulations on your $15 million asset sale announced yesterday. I'm sure you'll touch on that. And I'll turn it over to you to now go through the presentation and look forward to hearing what you have planned for the next little while.
Thanks, Jessica. Appreciate everybody attending today or listening to this on record. It'll be on our website. It's been a busy time at Pinecliff, even though the quarter itself wasn't, from a commodity price standpoint and from an operation standpoint, there wasn't a lot happening, from a activities something that we could talk about kind of publicly. You made reference to the sale that we did. That's been in the works for a while, so that's keeping everybody very busy. We'll talk about that a little bit in the presentation. And you'll find it some commentary on our president's letter and in our materials that are now posted on SEDAR. This is kind of the one thing I led off with when we were talking to shareholders this morning was that this is kind of the quarter that we've been looking forward to for some time. Fourth quarter of 2025, for some time we can see in the forward strip on natural gas prices that prices were going to be a lot better. We knew we had to endure and survive and navigate through Q2 and Q3. I think we've done a pretty good job of that. You would have seen the results that our realized price was quite a bit higher than the actual AECO price, and Chris can talk to that a little bit soon on the hedging strategy that we employed. But it feels like we're getting a lot of tailwinds for being a natural gas producer going into 26. And so has started now. And we'll touch on, some of the reasons why we think we've positioned ourselves pretty well here as we get prepared to go back to the drill bit, because we've got some locations that we're pretty excited to get to bring on production. And at the same time, I think we've done a good job of getting our balance sheet in a good, strong position to see if there's any opportunities for further acquisitions in 26. We think we're in a pretty good position for that. So what I propose today is we're going to do a quick walk through the presentation. And as Jessica said, if you've got any questions, please send them in and we will deal with them at the end of the presentation. So I think we always got to start kind of, if you're already a Pinecliff shareholder, as everybody on this call is, or at least all senior management is, this is kind of where we started. Why do we own Pinecliff stock? And it's quite often frankly drives why we continue to buy more Pinecliff stock. Is that I think we've established ourselves as a good allocator of capital. We've been doing this for 14 years now. The management team is very much aligned with the shareholder base because we have a lot of insider ownership. We're very fortunate that we've got one of the biggest pension funds in Western Canada is our biggest shareholder in AECO. That's the Alberta Investment Management Company. And so they manage about $180 billion, and that's our biggest shareholder. I think the reason why we're getting some attention now and why the stock prices started to move a little bit here in the last month is really around our high leverage to natural gas. And we'll touch on that a little bit, but Pinecliff would be one of the most levered names that you can buy in the Canadian space that's tied to the movements in AECO. And AECO is the Western Canadian natural gas price. And I think the last piece of kind of what I think makes Pinecliff kind of unique is that because of the really low production decline rate, so we've got a decline rate of less than 10%, that makes us one of the lowest of all companies public companies in Canada. That means that we don't have to spend as much money on drilling to keep our production flat, which then generates more free cash flow. When we talk about free cash flow, we talk about the cash flow that exists after we pay down our debt, after we pay all our capex expenses, and in our case, also after we pay the dividend. So how much more free cash flow do we have after all those things are accounted for? I think that's important because not everybody uses free cash flow in quite the same way when they're defining it. So, if for those who are not familiar with Pine Cliff, I mean, this is October numbers, so this will get updated here in the next day or two. Like I said, it's been a busy first week in November, but roughly a $300 million enterprise value company. We've grown from 100 barrels a day to over 21,000 BOE a day in as of the kind of 2025. We started in 2012. I think our stock range is in between for the last year has been between 50 cents and $1. I think today we're right around, I don't know where we're trading out right now, but high 70s. Um, we haven't issued any stock in 6 years. But we've done acquisitions through the last 6 years. So we're pretty proud of the fact that we're very, very focused on making sure that if doing everything we can to make sure that the shareholders on a per share value, we're increasing that all the time with our acquisitions and with our activities. And so there may come a time when we do issue stock, but it'll only be at a time where we think it's highly accretive to our existing shareholders. And I think having that really high insider ownership really kind of drives that. You can see here on slide 4, and by the way, this presentation is on our website, so you can access it at any time. We've had some in the last 6 years. We've had a variety of commodity price environments to deal with. Back in 2019, 2020, those were very, very low commodity price environments. Very proud of the fact that we still were able to generate cash flow, just wasn't a lot. And then, 21 was a better year. 22 was a phenomenal year. 22 natural gas prices averaged over $5 that year. And in that environment, we did $163 million of cash flow. So we went from $50 million of debt at the beginning of that year to $50 million of cash at the end of that year. And then what we sat on that cash. We started the dividend in 2022. As you can see, that gray line that's transposing that graph that's the AECO price on the right-hand scale. And so you can see that AECO, when over $5 in 22, really started to slide in 23, 24. We did an acquisition at the December of 23, so right at the end of the year. And that was the Certus acquisition. And Terry's going to talk a little bit about that when we get to a map. But that where we are now at 25 is we just announced our 3 quarters. AECO is now starting to move back up again. And so we got forwards prices of over $3 for next year on AECO. So in that environment, we start to generate some pretty significant free cash flow again. I think the differential between NYMEX and AECO is starting to shrink. We think that's going to shrink further. Just today, I just commented on the LinkedIn that to congratulating the LNG Canada because they just announced that their second train is now operational. And so that's good news for the Western Canada gas producers because that means there'll be even more gas being used as they ramp up that. Maybe I'll slide this or have Chris talk to this slide on free cash flow.
Yeah, sure. Thanks, Phil. So this slide is really meant to illustrate the leverage that we have to Canadian AECO gas prices. The chart on the right-hand side is a chart that comes from one of the brokers that covers us, Peters and Company. And you'll see here that they highlight on this chart relative to a lot of other natural gas weighted peers, our leverage to AECO gas price. And you can see here that we have more leverage than anyone else on this chart. And I mean, that's really not surprising is, over the years, a lot of the larger companies spent a lot of time diversifying away from AECO gas prices. And we did not. And we have chosen to hedge out some of those AECO gas prices. And so we've maintained that leverage to changes in AECO gas through the cycle and in going into 2026. The chart on the left-hand side is a chart that's meant to show magnitude of change of free cash flow, just to give an idea as to what exactly we're talking about. And what it does is it looks at our production base, it holds production flat on the left, and it shows the cumulative free cash flow that we would generate at different gas and different oil prices over a 2-year period. And that's on the left-hand side. And on the right-hand side, it shows the corresponding yield that would imply on our stock price. And so at 350, if you use 350 gas, and $60 oil as an example, we would generate over and above our capital spending about $42 to $45 million of cumulative free cash flow over 2 years that we could then put to work for things like additional debt repayment, support dividend payments, and potential strategic initiatives where possible.
Yeah, thanks, Chris. One thing I would just add to that is that left side that Chris put together really is quite conservative when you talk about free cash flow, because it already is assuming that we're putting cash flow towards dividends and to capex program. So you got to be a little careful, make sure you're comparing apples to apples when you compare different companies when they talk about their free cash flow yield, because a lot of, I think we're probably going to work with that graph a little bit to make it a little clearer, because it's, quite often you'll see that free cash flow companies will just be talking about they're all after their expenses and after their what their cash flow is, how much is left over that they can then apply to a dividend or apply to their capex program. In this case, we've already made some assumptions that we're keeping our current dividend going and our capex program, and on top of that, then this free cash flow is what's generated after that. We talked a little bit about the decline rate, and this just kind of illustrates it. I mean, we're on the very far left there is the lowest decline rate of the public companies. It's interesting, the average gas-weighted company in Canada has about a 32% decline rate. So when we're in around that 10% level, that's pretty significant. That's a big disparity. And again, that goes back to then how much, you can see it on the right side, what percentage of your cash flow do you have to spend on capex? And again, we'd be on the very low end there. And so that's kind of the model we've always built. When we started Pine Cliff back in 2012, the plan was always to build a dividend-based company. And so we got to that point in 2022 where we put the dividend in place. And the way we've grown historically has always been through acquisitions. We've done some drilling over the years, but fairly limited. It's kind of a new era since we did the Certus acquisition, because we've added some really, really good inventory. And maybe, Terry, I'll hand it over to you to just chat a little bit about the acquisition we did, and maybe even touch on the disposition that we did as well.
Sure, I will. Thanks, Phil. So up on the screen now, you can see a map of all of our properties, predominantly in Alberta. Up until probably a couple of years ago, until we did the Certus acquisition, the Pekisko was our primary play. It's in the Drumheller area. It's a horizontal 50-50 oil gas weighted play. If I went back, probably 5 or 6 years ago, we used to be 96% natural gas, 4% liquids. Till we started to develop the Pekisko play, we did a couple small acquisitions, and the Pekisko play and a few other things up until we did our Certus acquisition got us to be about 92% gas, 8% liquids. Added some oil exposure to help smooth out some of the edges on gas prices when it's down a little bit. So that was good. The Basal Quartz play is an emerging play in the Drumheller area. We still have some exposure to it, but some of the disposition we recently did included some of our Basal Quartz lands. It's not that we didn't like the play, it's just that somebody liked it a little bit better, and we felt we could put those proceeds to use a little bit better elsewhere. So in the Certus acquisition around the Sundre area, that's the one that we are most excited about, the Glauconitic play in particular. You can see it's 50-50 gas liquids. So it's a highly liquid weighted play. It's an overpressured glauconitic formation. Lots of activity on the play already. This would be the very first place where we intend to drill sometime coming up here very, very shortly. The team has been very, very busy, probably for at least the last year, on optimizing our land position and working with landowners to get surface locations and pipeline right-of-ways acquired. We've got 3 to 4 different drilling opportunities right in front of us right now. We expect to narrow that down into one here in the next week or two. And those would be the ones that we would drill right off the bat. Rate of return is great. They're sort of 8 to 9 million drill case complete and tie-in. The difference between 8 and 9 really is the tie-in. The well cost itself is closer to 8 plus the tie-in itself. The payout on them, very, very low payout. We've got good inventory, and that's our most prospective one. The Ellerslie is kind of a secondary play in the Sundre area. We've got great Ellerslie acreage. We think we've got a lot of really good locations on the Ellerslie. It's just not as developed as the Glock at this point in time. So I think our immediate focus would be on the Glauconitic. And then the Ellerslie would be a secondary play that would layer in probably in years 3 to 5. And then again, we pivot back to our Pekisco and I'd like to see perhaps depending on cash flow and how things go, we might sprinkle in a few Pekisco wells here over the next 5 years as well. So hopefully that helps. Is that what you're looking for, Phil?
Yep. Thanks, Terry. I appreciate that. One of the when we were looking at the disposition we did on the Basal Quartz that was announced this morning, this is for the last 14 years, the way we've acquired a lot of our lands is going to a lot of the bigger players and talking to them about areas where they're not spending capital and saying, well, if you're not spending capital there, then it probably makes sense that you sell it to someone who will spend capital on there, because the net present value of those assets is only going to be diminishing the longer you wait and don't spend money on those assets. That exact same argument applied to us when it came to the Basal Quartz, because as Terry just said, we're quite looking forward to the Glauconite wells. We think the Ellerslie's got really strong potential. That's more than enough to keep us busy for a lot of years. And so the view was we're probably not going to get to the Basal Quartz anytime soon, even though they're very good locations in a very good area. So if somebody else is willing to do that, it probably makes sense that we put it in their hands. And that's what we did, and the cash that we'll use to spend on our lands. So it was an important part, because we don't want to be doing drilling with debt. And so this helps us fully fund our program going forward, where we don't have to think about equity or debt. Allows us to continue with our operations as it is and keep the dividend intact. I mean, all of this is kind of based around, and I'm not going to spend too much time going through these slides, because you can go through them in your own pace. And a lot of you receive our quarterly email that goes out that talks a lot about the macro. And so we'll touch on some of these items, but I think I would highly encourage you to take the time and go through it and understand it. And if you've got further questions, by all means, send them to us. And if you're not already signed up for our quarterly email, please do sign up. Since we've been doing this for over 14 years now, we've seen a lot of different cycles when it came to natural gas. We talked a little bit about that earlier. We saw recently gas prices as high as $10 back only 3 years ago in the fall of December of 2022. So we think we're heading into what we call a tight market. The supply and demand is much closer than people believe, even though storage is higher than is typically been for the last few years. And a lot of that is because on the demand side. And that's what we'd like to, we'll focus a little bit about. I mean, demand is high, you can see on these curves, but it's not so much what it's at now, it's where it's going. And so in 2026, we think we're going to start to see significant natural gas demand increases. It's going to be in the short term driven by LNG. And so you can see that at LNG, and this is, we'll update these slides because they just touched close to right around 18 BCF a day of exports here just a week ago. And in October, they set an all-time record for 100 million tons of LNG exports. No country's ever done that before. This is the United States we're talking about. The United States went from 0 exports back in 2016 to becoming the world's largest LNG exporter. But they took a bit of a pause there between 2022 and 2024. We're now seeing that pause has stopped, and we're now seeing the incredible growth of LNG. And you can see that when you look year over year, just how much LNG they've added. But they're going to add another, it won't be quite the same wedge next year. They added about 4 BCF a day this year, another 3 BCF a day next year. This graph is going to be getting updated because there's new projects that have gone positive FID and got FERC approval in the US. So we're now talking about how it's going to be over 30 BCF a day of LNG exports going out of North America. That's an amazing large number. So when we talk about, you can compare storage numbers year over year for the last 3 years, and that's great. But the reality is we've never had this much LNG coming on at the exact same time. So, historically, natural gas was traded kind of on weather. And so quite often, as you head into winter, there'd be a lot of speculation. How cold is it going to be? Because that's going to drive how much natural gas gets used. And then therefore, a lot of gas will come out of storage, and you'll enter into next year with a lot less storage. What's different this year is that, yes, there's weather speculation. There always is, but you're seeing these huge LNG projects come on. And on top of that, you're starting to see a little bit, and it's still early days, of the data center demand. I just before the call here was looking at, they've just broke ground on another data center project in the United States that's going to it's going to be up to, I think it's several gigawatts, which means it's going to use a tremendous amount of natural gas. Some of the projects down in the US are using close to a BCF a day of natural gas just for single data center use. Bringing it back to the LNG, what makes it so advantageous for West Coast British Columbia is the travel time into Asia. So the biggest importers of LNG in the world are Asian markets. So it's China, Japan, Korea, Taiwan. And so being able to only have 10 days shipping versus 24 out of the coast, out of the Gulf, makes a lot of, there's a lot of economic reasons why that makes sense. LNG Canada is this project right here. It's a small area there's a town called Kitimat, BC. So this is up the west coast of Canada. This Coastal GasLink pipeline that was built has capacity for 5 BCF a day. LNG Canada Train 1, and just announced this morning that Train 2 is now operational. Train 1 and Train 2 are going to take it to about 2 BCF a day of exports. What the market is waiting for is LNG Canada to announce that they're going to go positive FID, which stands for Final Investment Decision, on the second phase, which will be another 2 BCF a day. These are big numbers, and just to highlight just how big the numbers are, all of Canada produces about 19 BCF a day. So when you bring on projects that are 2 BCF a day at each increment, you're talking about over 10% of all the production in Canada is now being exported out of those phases. So if LNG Canada gets to 2 BCF a day, probably by the first quarter, seems to be the trajectory that they're on. And if they add another 2 BCF a day in the next couple of years after that, in addition, you've got the Cedar LNG and the Woodfibre LNG and the Salisma LNG project. I mean, we could be in a situation in Canada where we'd be over 6 BCF a day of exports by 2031, which is now only 5 years away. So that's pretty impressive when you again reflect that back on the fact that we only make 19 BCF a day. I touched on this earlier. The other tailwind, if you will, around natural gas demand, and this is getting a lot of attention, is the data centers. Because the data centers are, so this is tied to artificial intelligence and your ChatGPT and all the applications that we're using that just use so much energy. Every ChatGPT search uses 10 times as much energy as a Google search. So there's the adoption rate of these applications is like, at a trajectory that we've never seen before. And therefore, a lot of natural gas is going to be required. And why natural gas is going to be required is because these data centers need to be built now. The energy demand is now. And therefore, things like nuclear are not going to be able to jump to the pump, if you will, in the time frame that people need it. And you also many of these applications need to have very high efficiency rates. In other words, they can't be intermittent powered, which then doesn't make it a good application for wind and solar. So the obvious, the energy solution is natural gas. And so you're seeing these huge projects get announced where natural gas is the primary source for these data centers. And Pine Cliff, I think, to date, is the only Canadian company that has announced its own data center. We announced that earlier this year. Hopefully, we'll be able to give you some updates. We're not building it, so we don't control the pace of its development. We talk to the partner on a regular basis, and they are getting everything put in place. A lot of the work's already been done so that they can get going. They're just finalizing the funding for this. And so hopefully there'll be some more news on that going forward. But it's an important piece because what the data centers that I think are going to show up the soonest and have the greatest impact are going to be data centers that are not connected to the grid. Everybody's grid is very much at maximum capacity these days, and it's getting built out. And so you're seeing a lot of these utilities that are announcing huge growth on to build out the grids. But in the short term, you really are needing to set up these data centers in areas where you can supply your own power. And that's where we think we can play a pretty significant role, because we've got, over 2 million acres of land across Alberta and Saskatchewan. We think we have multiple sites that could be really good locations where we can deliver the energy. They would put the data center right on our land, and therefore, and we'd be able to supply them the gas. The benefit to us is we'd be getting a higher price. The first deal we announced is priced to NYMEX instead of AECO. As we showed earlier, there's a pretty good gap between those two prices. And the second thing is for us, we don't have to pay any transportation costs. So that gas no longer needs to be sent on the TC Energy or the Nova system. We'd be able to just put it right into data centers. So we've seen the Western gas, this needs to be updated. The Western gas supply is now kind of, like I say, I've talked about that, 18 to 19 BCF a day. That's kind of where the gas supply is. It might peak it a little bit over that. I think it's peaked over right now. It's a shade over that because there's some flush production that's coming back online that had been shut in the lower AECO prices. The US it's gone up a little bit. It's, in around that 107 to 110 BCF a day is the numbers that they've got for their production. But again, with all of this demand coming on, we're going to need more supply. And so the question becomes, how do we get more supply? Well, you're going to need better pricing, because we've seen that if you have lower prices, the producers just won't go out and drill it. If it's not economic, they're not going to go spend the money. So we're seeing the higher prices now, and that's probably going to do what it should do. It should direct some more drilling activity, like ourselves, like we're going back to the drill bit, because now it makes sense. And I think that's all healthy. I think there's a legitimate question, though, about, can we really keep up? How are the producers going to keep up with the amount of gas demand that's coming on over the next 10 years? With the TC Energy slide we show on the right there, 45 BCF a day, that's a big number. We just talked, that's like almost three Canadas of production that is needed to be increased to and we talked about the fact that there's decline rates on all of the current production. So not only you got to replace your decline, you're looking to increase the amount of gas that needs to be put on the system. And a lot of these shale basins, especially in the United States, have been producing for a long time. So their productivity per well is starting to drop. So there's a lot of pressures going on that kind of behind the scenes you wouldn't kind of think about when you look at the current storage of where we are with Western Canadian storage and US gas storage. But this goes back to our comment that it's a lot tighter than what I think people are appreciating. And so this huge growth in supply and demand over the last 10 years on gas has not been reflected in storage being built out any larger. So, I commented on this in my email that went out yesterday. The days of coverage is down to the lowest. We're entering into this winter at the lowest days of coverage of natural gas I think it was in 8 years or 10 years. What that means is, if all the production was to shut down, how many days do you have of gas to supply the system? And that just shows just how, the storage hasn't grown, but the supply and demand has. So we think it's setting up pretty nicely. And on a longer term basis, it's pretty clear that the world's going to need more LNG. And there's a tremendous, and if you look on this right side here, you'll see that this is Shell's outlook. Shell trades in more LNG than any other company in the world, both as an importer and an exporter. And you can see that all the red is all the LNG that's in the world that's in operation. Yellow is how much is being built, we just talked about that. A lot of that is being built in the United States and in Canada, and very large. But even with that build, they're predicting that we're going to be looking at shortages of LNG by 2030. So it's a pretty bullish view on kind of where gas is going. And the one thing I'd come back to is, and for those of you who have been longtime energy investors, the one thing that's changed, since we've been running Pine Cliff, but I remember when we first started the business, but even before that, the industry for the longest time would spend more than it brought in. And the way they did that was that the market was very much rewarding companies that were growing. And so therefore they would give them more equity. They'd constantly be doing private placements and doing public offerings to give them more cash to grow. And the market was applauding that. But then that's changed. When you look back over the last 5-6 years, the amount of cash flow that the energy industries being able to bring in, and how much they're actually spending, the percentage of capex of their cash flow has dropped from over 100% to more closer to that 50-60% level. I don't think you're going to see that change radically going forward. And the reason I say that is because shareholders now really like the return of capital. And there's different ways you can return capital. You can the one way is to pay down your debt, because then obviously the enterprise value of the company is dropping, but the production and the reserves and all the asset value doesn't change. So therefore, the equity ownership is gaining as you pay down debt. Balance sheets are in a very strong position for pretty much across our industry, including at Pine Cliff. I mean, we're about 1.5 times debt trailing basis, but we'll feel we'll be under 1 times debt to cash flow in 2026. The other two ways to give back capital are to dividends and share buybacks. And so we've kind of chosen the dividend path as the way that we think is the best way to give it back. The monthly dividend is something our shareholders very much seem to appreciate. We have not bought back any shares to date. Who knows going forward? Never say never. But in our case, if we can buy assets at a lower cash flow multiple than what we can buy our own shares buyback, which has always been the case over the last 14 years, it seems to make more sense for us to be buying back assets. So that was a bit speedy. My apologies if I was a little bit fast, but the presentation's on the website. You can spend as much time there as you want going through it. There's other materials, other presentations we've done that you can take a look at. And like I said, if you're already a subscriber, then you would have seen some of the macro slides that we just sent out yesterday. Maybe Jessica, I'll open that if we have any questions.
Sure. I'll start with one from the audience. It's a bit long, and some of the things you did touch on already, but what particular factors will cause AECO versus NYMEX or Henry Hub to narrow from its 50-year differential towards historical norms? And I mean, I guess I'll let you answer it. Go ahead.
Thanks. So what we're talking about for the differential, for those of you who don't live and breathe this, you can see this slide that we've got on slide 4. And so the dark green is NYMEX, and then the gray is AECO. So NYMEX is the U.S. hub price that is typical right now. I think the forward strip for next year is a little over $4. I haven't checked the prices today, but it's a little over $4, I believe, is what NYMEX is. And AECO has closed a little bit this gap that the question is referring to. To next year, it's around $3 for the year for 2020 Canadian though. So you got to remember, NYMEX is US and AECO's in a Canadian price. My own belief, and this is shared by some of the other CEOs that I've heard speak on this topic, is that we're going to see this differential kind of close back up as LNG Canada ramps up. So you can look back at where it's been over the last few years, and it's typically been in and around that dollar price, and which makes sense because the transportation cost to send gas from Western Canada to Eastern Canada or the Eastern United States is in and around that dollar an MCF. So that makes sense that you would have that differential. I've been asked this question before, and I don't know the answer to it. Is like, well, as LNG ramps up in Canada, what happens to this differential? Is it ever possible that AECO could be higher than NYMEX? And that has happened before, periodically. I think for the short term, when I say short term, I'm thinking the next year, I think we're going to see that differential start to close again. And so we'll see it go back to more of the kind of a dollar Canadian, $1.20 Canadian, maybe differential between the AECO and NYMEX. But let's be all clear. We've never had LNG exports before in Canada. So we really don't know what the impact of having a growing LNG market off the west coast of Canada, what that's going to mean for differentials. And it does depend also what's happening in the US. Like, how desperate are they in need of natural gas? Will they be looking for more natural gas imports? Just, for clarification, today, we're 18, 19 BCF a day of total production in Canada. almost half of that would go to the United States today by pipeline. So, they're a big consumer of our Canadian natural gas. Now, they've been doing very well by buying it at a discount, essentially. And at the same time, they are exporting, we already talked about, 18 BCF a day of exports out to foreign markets. The JKM, the Asian market, is around $11-12 an MCF right now, and the TTF, the European market, is about the same level. So there's a real arbitrage that's happening with being able to send LNG out of the Gulf. In addition, they're sending another 7 BCF a day, almost what they're importing from Canada to Mexico by pipeline. So a lot of dynamics. The one thing that's changed since we've started at Pine Cliff is that it used to be you looked at North American gas prices and it was just a region, right? It was just you looked at kind of natural gas prices around North America, and it would be very much dependent on who got cold weather or who got really hot weather in the summer. It's changing now because the global impact of having LNG exports is coming on the system. Because again, prior to 2016, North America did not export any LNG, and now it's the biggest LNG exporter in the world.
Okay, and then the other question from this gentleman, how quickly can we add new supply? I mean, I think we can meet the 2 BCF of demand pretty easily, but if we do get to the 6, as you're forecasting, how long of a leg would there be for that?
It's a good question, and I'll let Terry think a little bit about that too. I'll start with we've never moved our Canadian production has never jumped by more than it's jumped by year over year 1 BCF twice, and so we can bring gas on. There is a lot of gas in Western Canada. There's no argument there. The Montney and the Duvernay are 2 examples of 2 huge shale plays that are just in there we're all coming off the baseball season in the early innings. But asking the supply chain system, in other words, all the rigs and the crews and the fracking, and to drastically increase production, let's say we need 2 BCF a day. I'm not saying it's impossible, but it's not been done before. It really is a new era we're going into with bringing on 2 BCF a day of new export and another 2 BCF a day of exports. The problem that we had on storage, why it's so full in Western Canada, is because the producers got ready for LNG Canada phase 1, maybe too early, but they got ready. In other words, we raised production, and you can see when you look at the supply here, you can see how much higher 2025 was than 2024, and that's because the producers went to the drill bit. They brought on a bunch of gas production, waiting for LNG Canada to come on. And again, maybe they brought it on a little too early, which created the storage glut, and therefore we had weaker prices in the commodity prices. For the ability to move up rapidly, I don't know, Terry, what's your thoughts on that?
Like that, it is a very good question, and it's a difficult one to answer. I mean, you talk about the supply chain issues, and there's no question with regards to rigs, equipment, services. Those are all an issue. I think the other key piece to think of is the infrastructure itself. Every new well that comes on, in order to get 1 BCF at the sales meter, typically you need at least 50% more than that at the wellhead, because all the wells compete with themselves and there isn't unlimited access. I mean, that's one of the challenges that we've had in the basin itself, is our infrastructure, our takeaway capacity on the NGTL system or the TransCanada system or even the Enbridge system they're limited. So, just to say we're going to add a BCF or 2 BCF, you really are adding significantly more volume at the wellhead. And it's a good question. I'm not sure there really is a good answer, but it's certainly not instantaneous. I would say there's certainly a lag between when the drilling starts and when we might get there. But I mean, as Phil's pointed out, there's several other LNG projects in the mix coming on as well. So, I think it's all going to layer together, and it feels like it's going to, as the production grows, the LNG offtake is going to continue to grow. There's probably going to be momentary periods of oversupply or undersupply, but I think they're probably going to grow together. because there's just logistically, both on the supply chain and the infrastructure, there's a lot that needs to be done on both of those sides.
Yeah, the only thing I'd add to that, and I agree with you, Terry, is if commodity prices are to go up dramatically, that's obviously going to help to grease a lot of the wheels. But the inverse happens is if you have really low gas prices, or even the low oil price has an impact on gas supply as well, both in Canada and the U.S. In the U.S., it's really the Permian Basin's been the source of growth of gas supply, and it's because of the oil drilling. But oil's weakened here recently, and so now you're seeing drill rigs starting to go down in the U.S., which means gas supply is going to be dropping because of that associated gas. Up here in Canada, it's not so much the oil price that drives the gas supply, but it is the liquids, and so the condensate drilling. So, which is very tied to oil prices. So if oil prices do not, if they're muted in 2026, 2027, you're not going to have that same economic incentive to be out drilling in either country for different, one is for the natural gas liquids, one is for the oil. What that means is you're going to need a higher gas price to motivate producers to go out and drill. So it's we've been through these cycles before. Anybody who's been a long-term investor in oil and gas knows that the industry has, when we have the old adage is a cure for low prices is low prices. Because if you have low prices, then all of a sudden there's a lot, at some point, drill rigs go down, demand still stays high, and at some point the prices have to go up to generate more drilling. This environment with the LNG and now the data centers, don't forget about the data centers. In Alberta alone, the data center growth we're talking about could be several BCF a day of extra demand. That's like an entire LNG facility coming on. So a lot of interesting dynamics. I think it's safe to say we're all looking forward to the next couple of years to see how this is going to play out, because we really think it's going to play out well for natural gas producers.
Okay, I have a couple questions as well. On the acquisition front, as you've been very astute historically in doing acquisitions, and with gas prices having been so low for the last little while until just the forward strip now looking great, is there anything for sale that you would be interested in, and then you could certainly lock in the returns with hedges right at this point?
Yeah. I don't know if in the last 14 years if there's probably been the odd day, but there's a very rare that we're not looking at something at every given, every day. And it's quite often where we got a couple more than one thing that we're looking at. I think we have proven that we've got a discipline to our acquisitions. We haven't done a major acquisition now since almost 2 years, right? It was the end of 23. And that's not unusual. We've had a couple periods of time. We've done about 16, 17 acquisitions over the last 14 years. At times we've done more than one in a year, and then there's been a few times where we've had a couple-year gap. We were digesting this last one. We're constantly now have kind of amped up our efforts to kind of keep an eye and look for other acquisitions that would be a good fit. I'll be disappointed if we don't find something in the next year to add into the mix. But that's if we don't, we don't. We don't have to. From our standpoint, we are pretty clear that we're only going to do it if it's accretive and if it's only going to make sense to shareholders. So hopefully we'll find something. There are things out there to directly answer your question. There's several processes that we're involved in. We think there's going to be more. There's been a lot of consolidation in our space, and whenever that happens, eventually non-core assets come to market that they're not able to spend capital on, and that generates the opportunity for someone else. So we're optimistic that we'll be able to find something.
Okay, thanks. And just on the Glock wells, so you're going to spud the first one before the end of the year, would you say?
The timing is still not determined. As Terry mentioned, we're talking to partners in the area. We've got a few different options on how we want to go at it. So that hasn't been firmly determined. I think the point is we want to get to it as soon as possible, and if we can spud the first well in Q4, fantastic. But we're not going to, we're making sure that we've waited this long. We're going to make sure that we've got the right location with the right partners, and it looks like we're going to have the right commodity price environment. So we're stay tuned, more to come.
With success, would you drill like maybe a 2 or 3 next year?
I think that's to be determined. I think the plan right now, we haven't set a budget for next year, but we have talked to the board about, kind of where our hope would be to drill a couple of wells next year, net wells to us, but we haven't, it does depend a little bit on kind of the success of the first one. It clearly depends on kind of where commodity prices are, but I don't think you'd see us doing ramping up too quickly. I think kind of in that, if we were doing a couple net wells a year, maybe we're at some point where we get up to 3, but I think that we'll walk before we run. And so the idea is to let's learn more. We're learning a lot by watching others drill in the area, but I think you obviously learn a lot more when you drill yourself. So we're kind of looking forward to getting that first one going and then build off that.
Okay. And one more question on hedging. You have what, 32% of your production hedged for next year? Is that correct?
Yeah, Chris, if you want to take the hedging question.
Yeah, that's correct. Yes. Yeah.
So what would be your ideal amount? Would you hedge more than that for right now, or are you going to hang up?
Yeah, no, I mean, notwithstanding the fact that we are obviously constructive on gas prices and think that they're going higher, we do think it's prudent to lock in a certain amount of cash flow, particularly when we've got a development program going, not only to protect the capital that we're putting into the development program, but also for our existing dividend and whatever debt payments that we're scheduled to make during the course of the year. So I think, as the year progresses, we'll continue to look to do a little bit more. If you would have extended out, and you'll see this when we update the presentation, the profile out to the end of the year, you can see it kind of tapers towards the end of 2026 and into 27. So I think, locking in some more prices as we move into 26 and as the strip holds, I think would be something that would be prudent and will continue to do, particularly through the summer months, which have traditionally been the weaker quarters from a gas perspective in Canada.
Yeah, you never know what can happen in the summer. Yeah.
This is true.
Okay, well, I don't have any other questions. That was a great update and a great macro update. And I don't think there's any more questions from the audience. If anyone has any further questions, please reach out to me and I can put you in touch with Bill in the group. Or if you'd like a one-on-one meeting, I can also arrange that. But I think we've touched on pretty much everything. I don't think we missed anything. Do you think?
Excellent. Well, thank you very much, Jessica, for hosting us, and thanks everybody who listened in.
Thanks. Have a great afternoon.
Yep,
Thank you.
Take care. Bye.
Thanks. Bye-bye.